Ladies and gentlemen, many of us are crazy about gold right now. Gold prices are going high and high and high and higher. And right now, everybody think that this is unstoppable. But Goldman Sachs just came out with this big warning on gold. And let's just watch what this warning is all about. So today's title is Gold is having a bull run, by Goldman Sachs is warning that danger is ahead. In an article, investors flocking to gold for safety may be making a big mistake. Wow, that's quite dangerous, right? So Goldman Sachs is basically saying that, that gold that's glittery and glittering may not be glittering for the next period to come. So investors just poured nearly $1 billion into a popular gold ETF. So let me just say this categorically clear, as explained by Goldman Sachs, is this: that gold is not risk free. A lot of people think that just gold is the most stable asset on earth. Wrong. When when something goes up really very high astronomically, we just got to be careful that is this just a gold rush, or is this the start of something quite dangerous? Now, gold has been hitting record high after record high after record high. Now, I do sell gold as well as part of my premium mall work, and we sell gold to ladies customers from Taka Jewelry. We get very good wholesale prices, and I also buy them. See, even Mr. Lu is wearing gold right now as a gold chain for the first time in 50 over years. But I think the idea that gold will be rushing up forever and is a safe asset is something that we just got to be very careful of. Now, what investors like to believe is gold is a great protection against inflation, and gold is a wonderful asset against crisis. Now, gold, on the other hand, many people think that it doesn't crash like equities, and you always can preserve your wealth if you buy gold. Is this all true? What history actually shows is this: that gold can crash by 70%. That's really very high, 70%. And it's not trivial. And the volatility of gold actually is worse than equities if you compare it to a broad base of US stocks over a long period of time. And once it crashes, it can last for a very, very long time. Take a look at this graph. It basically shows from 1975 to 2025. This is the gold spot price, okay? It goes through a huge decline, okay, for a long period of time, right? 70% at its worst. So this is quite frightening as compared to the stock prices, which don't decline by that much. So gold versus other true stability asset is very far off. Bonds generally offer very low volatility and is income producing. They produce dividends and so on. And to some extent, the cash flow from bonds are predictable. Gold, on the other hand, apart from the fact that it's glittery and it's nice to touch, okay, actually have no yield. It doesn't give you a dividend or doesn't give you a return in any way, in the hope that someone will pay a higher price for it. So it is no wonder that it has its own struggle as well. So to think of it as a stable asset, I think is a wrong perspective. It's more a speculative asset. Is gold a powerful inflation hedge? Well, in the long, long, long run, yes. But in the medium term, maybe only sometimes. So gold over a 20-year period only successfully hedge against inflation half the time. And that's quite serious to think that gold is a protection against inflation. And US equities have always beaten inflation over a similar period. So I don't think that we should trust gold that much, that what everybody is feeling. So if you take a look at this graph, it will tell you the various returns, okay, over a long period of time. And on top, of course, is US equities, and gold prices is somewhere around here, okay? So US equities is really a better hedge than gold. Now, granted that, yes, this year gold went up by some phenomenal amount, but you cannot take a look at this 1 year spike, right? So gold historically, as quoted from Goldman Sachs, have higher volatility than US equities, has much larger drawdown, and is effectively a hedge against inflation, which means that uh, it produces a real return, okay, over a 20-year period, only about half the time. And US equities, of course, is better. So when does gold go up? Well, gold will actually have his powerful shine when there is political instability, fear, chaos, wars, okay, upheaval, in some form, or when there's monetary anxiety where people don't trust currency anymore. There could be, just speculative bets on gold, like right now. Now, a lot of people might say, okay, gold, not so good. What about silver? Well, silver historically has even higher volatility, right? It exceeds gold price swing, and when it comes to drawdowns, have even steeper drawdown than gold. So it amplifies the upside, which is great, but also amplifies the downside. So the joy will be higher and the pain will even be worse. Is that something you really like to touch? Well, the real question investors in gold should ask this. Well, can you tahan, a volatility downturn of 40 to 70% without panic selling? Can you hold it over 10, 20, 30 years? And is it trying to chase this over a short term, or are you going to hold this for long term? And if it crashes by 70% over a long period, can you take it, right? If you can't, then you maybe want to reconsider touching it. So just to recollect everything, what goal is not, it is not a preservation of wealth in the short to medium term. It is not a savings account, okay? And it's certainly not capital protected, and it's very volatile. It's not volatility free. If you buy to wear it and enjoy, put earrings and bangles and rings like that, that's a different story, right? It uses as more tangible kind of a pleasure, and that's fine in that sense. But if you use it as an investment, then most of you all will not buy physical gold because the trade value is not as high. You will buy digital gold in a sense, like paper gold. And when you do that, you don't get pleasures from it, and then you really treat it as an investment asset. Then it may not actually serve the purpose you want. So gold is probably a diversifier, okay, and maybe it's one of the asset that you diversify away from your bonds and your equities, and you just got to prepare that there will be sharp drawdowns. So as like all asset, if you cannot afford to lose, then don't touch. Yeah, then don't touch. And if you think that you cannot handle the uncertainty of all this volatility, don't touch. If you don't understand how the movement is, don't touch. It is okay. You can still do very well by just putting your money into the S&P 500 and hold for a long period of time. You do very well, or you just put it into the CPF in a special account or your retirement account. You do very well as well. These are things that maybe you want to reconsider touching them rather to get burned badly. So maybe you got to rethink about your goal strategy. So in a nutshell, like all investment asset, we need to have a investment strategy. Buying speculatively, believing that you go up, okay, over the next short-term period, I don't think is something smart. So, unless you hold it for a long, long, long period, it will protect you against inflation, and that will be great. But other than that, maybe you want to reconsider because gold may not shine at the time that you want it to. Thank you for watching, and I'll see you again. Bye-bye. So we're now barbecuing the vegetable starters before the beef comes. And this is one of the best Wagyu beef barbecue in Mount Austin. Very exciting. Okay, we shall see. The Wagyu beef just arrived. Wow, look at that, man. Wow, this is really Wagyu beef. That's amazing. And that's the tongue. Okay. Wow. Once this is done, we'll go for the kill. So right now, the beef is about to be done. Okay. Wow. So I'm going to eat the beef now. Wagyu beef. You can feel it's fatty. Very good. Very, very good. Yummy. I'm gonna try the beef tongue now. Just barbecue. This is the beef tongue. Okay, one piece just cooked. I'm gonna eat it right now. Beef tongue. A bit tougher. Not that kind that melt in the mouth. I put some salt. Good. Yummy.